Okay, everybody got on MindTap okay? You got all found your way there? Pretty much. I didn't check it today. I've been playing with a Wi-Fi extender. That I spent 45 minutes on chat with Netgear, and she finally got it to work, except when I moved it up where I wanted it to extend, it didn't work. So we'll try again tomorrow. Anyway, right now I've got a signal. We should be glad that we are not in South Haven, because I just saw a post of someone holding a golf ball sized piece of hail in South Haven. This is a good day to not be there. Okay, what we're going to do today. First thing I'm going to do is look at the chapter 1 questions, which there weren't that many of them, but I need to share my screen. That's chapter 3. That's not the one I want. Why can't I just share my screen and you see what I see? There. Are you seeing chapter 1? Are y'all seeing chapter 1 questions?
Right.
Okay, good. There was only two or three. Okay. First one, let me scroll down here. When is a stock said to be in equilibrium, and why might it not be? It's an equilibrium when the true value and the market value are the same. The reason it might be out of sync is because typically investors get news and prices move on news. So we can temporarily get them out of sync. We read the news wrong, it's a rumor, whatever. Most of the time, because of technology travels so quickly, most of the time ours are in sync. Let me put the book over here. Suppose 3 honest individuals gave you their estimates of Stock X's intrinsic value. One's your current roommate, the second is a professional security analyst with an excellent reputation, and the third is Company X's CFO. If the estimates are different, in which would you have the most confidence? The CFO. He's an insider. Insiders always know the truth. The rest of us are watching the signals from the outside and trying to figure out what's really going on. Okay, going down here. It asks you about the forms of business organization, proprietorship, partnership, and corporations. They include limited liabilities. Disadvantages, we saw them all on the slide, of proprietorships and partnerships. Difficulty in obtaining large sums of capital, unlimited personal liability, limited life. Basically the same thing, difficulty of transferring ownership for partnerships. For corporations, the disadvantage is double taxation and having to set up the corporate filing with state and federal reports, which is quite time consuming. The advantages for a corporation, of course, are limited liability, indefinite life, ease of ownership transfer, and you can raise money. Let me get that off my screen. And I think the last one. Oh, yeah. And I will read it here. Suppose you were a member of Company X's board of directors and chairperson of the company's compensation committee. What factors should your committee consider when setting the CEO's compensation? Should the compensation consist of a dollar salary, stock options that depend on the firm's performance, or a mix of the two? I don't know who's calling, but I'm in class. Sorry. If I don't answer it, it'll just keep ringing. If performance is to be considered, how should you measure it? Okay, and then they ask about the vice president. You think about this, CEO of a company. If you want to attract good talent, you're going to have to pay them a base salary. That's just all there is to it. You have to. But if you want to align their motivation with what you want for the stockholders, which means upping the stock price, you better put in some stock options. What again? Yeah. I'm in class. I'm in class. Yeah, bye. No, that's okay. I'm sorry. She didn't hear me when I said it before. Sorry about that. Anyway, you have to structure it in such a way that there's something that motivates them to increase the stock price for the shareholders. Now, when you're talking about performance, it's performance over the long run, because they could do some things that would bump the stock price so they could exercise the options, cash out, and stockholders wouldn't be any better off. So it's a difficult thing to set up. And there you're seeing it right there at the bottom. Should probably set the compensation as a mix between fixed salary and stock options.
Is this available where we can look at it on Blackboard?
No, sorry, it's not.
Okay.
This is not. But you can see it right here. Okay, that was chapter 1, which was really just kind of an introduction. I am going to talk about chapter 3. Chapter 3 and 4, basically they're accounting review. That's exactly what it is. In this chapter, we're going to look at the key financial statements, balance sheet, income statement, statement of stockholders' equity, statement of cash flows. We're going to look at free cash flow. We're going to look at economic value added and market value added, both of which I can tell you right now, I will not ask you because I don't like them. And I'll say why. And then we're going to end with the federal tax system. Now, this is not an accounting class, so you don't have to actually take numbers and create these to some extent. Annual report. You all already know this. The balance sheet, it's a snapshot, point in time. It'll be the balance sheet of ABC Company as of January 25th, 2021. The income statement is over time. Inside a company, you're probably going to get them every accounting period, every month, every quarter. We'll be looking at them that are annual. They start with sales or revenue or something else and end up with net income. Statement of cash flows. This one is important to us, and we're going to talk about why. And the statement of stockholders' equity. Now, we're going to talk about each one of them. How we're going to look at it is through the case that's at the end of the chapter. This is De Leon. They're a snack food company. And back in about 2017, they decided they were going to do a big expansion because they wanted to compete with Frito-Lay. Now, they make nut snacks in Florida. Well, it didn't go very well. They did the expansion in 2018 and it did not go well. And we'll look at their statements, you'll see. Their cash position has declined. They're paying suppliers late. Board of directors has said, you got to do something. Here's the asset side of their balance sheet. 2018, before the expansion, 2019, after. Cash position declined significantly, but accounts receivable and inventories went way up. Net fixed assets almost tripled. No surprise, they did an expansion. On the liability side, everything went up. Accounts payable, accruals, notes payable, long-term debt, everything. Retained earnings went down. Now remember, think back to your accounting class. When you get to the end of the income statement, net income, you can only do two things, pay it out as dividends or add it to retained earnings. Either way, it belongs to the shareholders. You're just keeping it to reinvest in the company. So if this goes down, we need to see what they did. Here's their income statement. Well, sales went up, but so did cost of goods sold. So did everything, really. The big thing is net income went from a positive to a negative. Not good. Here's what also happened. Check those. Earnings per share went down. Dividends per share went down. The stock price went down. Now think about this. The company did not make money this year. They lost money, but they paid a dividend anyway. More than in half, but they paid. When we get to, I think it'll be chapter 7, we'll talk about why that is. Nope, be 9. Chapter 9, we look at stock. Shareholders expect a dividend. If you can pay a dividend, you need to keep paying a dividend. To reduce the dividend is a really negative signal to the market. To cut it out entirely is very negative. So they elected to pay it anyway. their stock price. You better believe their stockholders are not happy. Stock price, pardon me, went from 850 to 225. Now, here's a statement of stockholders' equity. Here's where those dividends came from, right there. They started with 203,000 in retained earnings. They lost money, so there was no net income to add, but they paid dividends anyway. They paid it out of that 203. It belonged to the shareholders anyway, so they paid that. You can't see that, at least I can't see it totally at the bottom, but negative net income, yet the firm paid dividends. Now, statement of cash flows. Why is it important? This is the only place where we can reconcile the income statement and the balance sheet to cash. Now, the income statement and balance sheet are both accounting statements. They use a matching principle. There's accruals. There's a lot of things involved in there that don't involve cash. Think about depreciation. From a finance cash standpoint, if you buy an asset for $100,000, you just spent $100,000. From an accounting perspective, you depreciate that over its life each year to match up the cost of the asset with the revenue generated by the asset. That's accounting. Finance is concerned with cash flow. And bottom line, which is what that all says at the bottom, you can manipulate net income, but if you cannot convert into cash, it's not worth anything. You need cash. Cash can't be manipulated. Either you have it or you don't have it. Statement of cash flows has three parts: operating, financing, and investing. This is the operating side. And you can see it. It starts with net income, which, since it was negative, it's going to drive everything else. Now, we are not going to go into filling in for you to need to fill in all of these things. These are sources and uses of cash. Here's the point. Their net cash provided by operations is negative. For a healthy company, it ought to be positive. If a company says we make widgets, they should make money making widgets, not financing or investing, but making widgets. Now, in this case, this is driven by the negative net income. The investing, they spent over $700,000 on net plant and equipment, right there. And they increased notes payable and debt, but they paid dividends anyway. How did they finance that plant and equipment? My internet connection is unstable. I know. They financed it with notes payable and long-term debt. Bottom line, if you add the bottom line of those three sections together, they're decreasing cash and ended up with only $7,000 end of the year. Now, this just kind of recaps it. Net cash from operations was negative. They had high negative net income. They borrowed $800,000, and even at that, they still had to get into cash. Now, here's how it's put together. Now, this would be what you do need to know how to do. Beginning of the year cash, $57,600. Cash from operations, negative $164. Investing, a negative $711. Financing was an income, $824. You end up with the end of year cash. That's got 5 pieces to it. Given any 4, you should be able to algebraically solve for the 5th one. Okay, from accounting, net working capital, pretty easy. Current assets minus current liabilities. Brigham at Houston have a more refined definition. Net operating working capital. It's operating current assets minus operating current liabilities. Current assets minus excess cash. De Leon doesn't have any, but they do have notes payable. Here's the idea. Excess cash is typically short-term investments. Payable is it's a financing liability. Now, and we're going to look at doing some of those. Did the expansion create additional after-tax operating income? No. It was, their operating income was 142 last year. It's negative this year. What effect did it have on net operating working capital? Well, they needed a lot more of it. no surprise, they had a lot more liabilities. Here's the kind of the overall effect. Sales went up, but everything else went the wrong way. Not very good. Now, this may be new, free cash flow. There's the definition of it up there, the formula for it. Free cash flow is EBIT times 1 minus the tax rate plus depreciation and amortization minus capital expenditures plus the change in net operating working capital. Okay, all of those, we just looked at net operating working capital. You can find all the rest of these, and we'll look at where they are. The one we need to talk about is capital expenditures. It can be either the change in gross fixed assets or the change, there you go, which is from either the statement of cash flows or the balance sheet, or the change in net fixed assets plus depreciation. Now, in DeLeon's case, I'm thinking the balance sheet had gross fixed assets minus accumulated depreciation equals net fixed assets. So we could do it either way. A lot of times, the balance sheet only shows net fixed assets. So you would need to use the second definition right there. For DeLeon, there it is. Free cash flow for this year in 2019, a minus $744,000. Is that always a bad sign? No. Truthfully, it's not. When a company is involved in an expansion, it's not necessarily a bad sign. In this case, they've got other issues as well. So yes, it is a negative sign. Okay, here's where the parts come from. Here's their income statement. There's EBIT. There's depreciation and amortization right there. Current assets, there they are. Gross fixed assets are right there. Net fixed assets are right there. Current liabilities and notes payable, so you can exclude them. They're right there. Put all that together, and that's how we got that number. Okay, here's the two I'm not crazy about. Accounting statements are insufficient for evaluating managers' performance because they do not reflect market values. That's true. They want to look at market value added, which is the difference between the market value and the book value of the firm, and EVA, which is economic profit for a year. Here's what it looks like. MVA, market value added, price per share times the number of shares. That's how you get the market value in there, minus the book value. Economic value added, you can see it down there, is net operating profit after tax minus the annual dollar cost of capital. Now, here's how this works. For DeLeon, MVA for 19 was a negative amount. For 18, it was positive. What that means is, what you're looking at here is how much value has been added to the company since it was founded. They had added, they've lost some. So shareholder wealth was destroyed with this expansion. That's the point. EVA is, it'll say it in the last one, EVA can be calculated on a divisional basis, but it's on an annual basis. If it's positive, then your operating income is more than the cost of capital. If you have positive EVA every year, then you'll have a positive MVA. MVA is the whole firm. EVA can be divisional, subsidiary, something like that. Just stop and take a breath and ask if you have any questions. Some of this might be new. Okay, do we think they're paying their suppliers on time? Well, probably not. Their accounts payable increased by 260%, while sales only went up 78.5%. So what do you think is going to happen? Well, suppliers are probably going to put them on a cash on delivery basis to begin with, and eventually they'll just cut them off if they don't pay. Does it appear that their sales price exceeds the cost per unit sold? No. After-tax operating income and the decline in cash shows that they're spending more in operations than they're taking in for making whatever it is. I love this one because I know what's in the next chapter. What if DeLeon's sales manager decided to offer 60-day credit terms to customers rather than 30-day credit terms? Well, I can tell you right now, I'm in chapter 4, and their customers aren't paying in 30 days right now. If he does, and if competitors match the terms, all that's going to happen is their AR is going to go up and their cash is going to go down. Consider if their customers right now under 30-day terms, let's say they're paying in 40 days on average. Well, if they offer them up to 60, they're going to start paying in 70 days. If their competitors don't match it and it does increase their sales, then in the short run, they're going to have to increase their inventory to meet the need. And they might need financing. In the long run, it could improve the situation. And we saw how they financed their expansion. Long-term debt, a lot of it. Would they have required external capital if they had broken even? Yes. Yes, they would, because if you look at the statement of cash flows, they invested that much in net fixed assets, so they would have needed to raise capital. What happens, you know, the new tax law, you can immediately expense qualified business assets rather than depreciate them. Suppose they did that. Well, it wouldn't affect the assets at all, obviously. Fixed assets on the balance sheet would go down. Depreciation would go up so high. Net income would decline in the year that they bought it because you're subtracting the whole value of the asset. Tax payment would decline. The cash position would improve. Okay, last topic in the chapter, taxes. And unfortunately, we're coming into tax season. Whoops, I have no idea what did that. Get back down there. How do I make that go away? Go away. Go away. Thank you. Okay, taxes. Okay, new tax legislation in 2017. No telling what's going to happen this year. It reduced the corporate tax to a flat tax rate of 21%. For years, we have used a corporate tax rate of 40%. 35 corporate plus federal plus about 5 state. Now we're using 25, more or less. And the business interest deduction has been limited. Here's what the income individual tax brackets look like in 2018. Single taxpayer, married taxpayers. And we're going to look at a problem of computing taxes. From a personal tax standpoint, let me say this. You should do your own taxes because you should start doing them now while they're easy, because you don't have a lot of deductions. You don't have a lot of other complications. Start now so that as things get more complicated, you understand what affects your tax situation, so that you can do them yourself. So I highly encourage it. Okay. Tax treatment of various items. Interest paid is tax deductible for the corporation. Think about where it is on the income statement. It's one of the things you subtract out before you get to net income. For us, for individuals, the only interest that's tax deductible is on home loans. Now, years and years ago, it used to be all interest, credit card, everything was tax deductible. It's not anymore. Now only home loans. Interest earned, it's fully taxable unless it comes from municipal bond, which we'll look at in Chapter 7. Dividends. Dividends are paid out of after-tax income. Think about again where they come on the income statement. That's where the issue of double taxation comes in. For a corporation, dividends are paid out of after-tax income, but paid to me, I'm going to pay tax on them again. And you can see the breakdown here. Generally, low income pays nothing. Most of us pay 15, high income pays 20, I'm sorry. And for corporations who own non-controlling interest in other corporations, I think it's 70% of the dividends are tax excludable. How that plays out typically is one corporation may own preferred stock in another. So they no voting rights, so they don't control it, but they can exclude 70% of the dividends. Okay, there's where it's double taxation. Now, tax code allows firms, my internet connection is unstable again. And I thought about being downstairs. Let me say this. I thought about being downstairs today and doing it down there where I'm within 5 feet of the router. it was thundering and lightning, and my dogs don't like that. So it would be disruptive. Tax loss carry forward. Firms can carry losses forward indefinitely to offset profits in the future. Now, individuals, we can too. We can carry losses forward. Capital gains. Let's talk about what they are. Capital gain is the profit or loss, actually, from the sale of an asset, not normally part of your business. Capital gains for individuals, they fall into two categories. Short term is a year, if you've owned it a year or less. If you've owned it longer than a year, it's considered a long-term capital gain. Corporations don't get any kind of treatment for that. We more or less pay 15% on long-term capital gains. Think of this in terms of stock. If you bought it and sold it within the same year, it's considered ordinary income. If you've held it for over a year and then you sell it, it's a long-term capital gain. That into chapter 3. Was that new? All silent out there. How do I get me back? Meeting controls.
I'm sorry, can you repeat that? It's kind of, I don't know if it's partly your connection and my connection, because my computer's a piece of crap and I have one on the way that I've ordered.
It probably is.
Be a combination of the two. So it's hard to figure out what you're saying sometimes.
Yeah, see, I'm not hearing you very well either.
Yeah, hold on. Let me go back to my router.
Maybe put it in the chat. Maybe put the question in chat and I can, because I couldn't hear you. It was like slow motion. It was strange. It was like slow motion. I know I went through that quickly, but most of y'all have probably just had accounting. And other than the free cash flow thing, there's not much of it that's new. Okay, did you put something in chat? Okay, we will look at the questions for chapter 3, and then we'll look at the problems for chapter 3. Let me get the book here. Now, since y'all hadn't had me before, I talk fast. Did you notice that? So, but I am perfectly okay if you interrupt me anytime. It's okay. If you want me to slow down, go back and repeat something, whatever, I'm fine with that. But I just naturally talk at a fairly good clip, and I'll just keep going if you don't stop me. Okay, first question. What are the 4 financial statements? Well, duh. Balance sheet, income statements, statement of stockholders' equity, and statement of cash flows. And the last one, looks like the storm's blown past me, I hope. How does the deductibility of interest and dividends by the paying corporation affect the choice of financing? Okay, think about this. The government, our tax laws allow you to deduct things that they want to encourage you to do. You deduct the interest on a home loan because we want to encourage people to buy a home. Well, corporations can deduct the interest on debt, but they cannot deduct dividends. Hence, we are encouraging corporations to take on debt. And we'll talk about that. Actually, that's a capital structure issue, but that's exactly it. It encourages the use of debt. Okay, let's look at the problems. And I don't think there's too many. 3. Let's look at this one. Oh, go away. Let me shut this down. See if I can get it all on one screen. Yeah, I can. Okay. And I'll read you the problem and then show you what they're talking about. Assets of Dallas and Associates consists entirely of current assets and net plant and equipment. The firm has no excess cash. The firm has total assets of $2.5 million. Net plant and equipment equals $2 million. notes payable of 150,000, long-term debt 750, total common equity 1.8. And they only finance with debt and common equity, no preferred. Okay, this is like a little puzzle. They've given you net plant and equipment, total assets, notes payable, long-term debt, and common equity. And they want you to basically fill in the rest of the balance sheet. Well, how about let's just start right here. If they gave you total assets, then they have to balance. It's a balance sheet. Total debt is long-term debt plus notes payable.
Is this not on Blackboard either where we can see it?
No,
So you can't share
Nope,
your
it's
screen
not.
account where we can see it? Okay.
we as a department policy, we do not post the solutions to problems. So we'll post the answers. I can share the blank with you. I can share the blank of it.
Yeah, share the
I can-
blank, please.
Yeah.
Yeah, because
Okay,
I
I'll
mean,
just-
I can barely
Yeah,
hear
you're
you,
cutting
and you're
in.
just cutting off,
There
and
you
I
are.
don't know what's going on. So
Oh, bless your hearts. I know. If I don't do it tonight and send you an email, send me an email and remind me, okay? That's a general rule. If you ask me to do something and I don't do it, send me an email. It used to be I would say by the time I drive home, I'll have forgotten it. Well, by the time I get downstairs and feed the dogs, I may forget it too. So it doesn't bother me to be reminded. Remind me, okay? Okay. Total liabilities and common equity. Well, if it's a balance sheet, they have to equal. Current assets. Well, if we've got total assets and net plant and equipment and we don't have anything else, then this is the difference. So it's 500,000. Current liabilities. Well, if we have total liabilities and we have those two, we can just subtract. It's that minus the two above it. 250,000. And if we have that, then this has got to be the difference between these two. So I have just succeeded in filling in all the blanks. Then it asks you for net operating working capital, which is current assets minus current liabilities minus notes payable. We leave them out. And net, oops, that was net operating capital. Sorry about that. Move that one. Move that one down there. Up there. Net, your basic net working capital is that. And the difference, of course, is notes payable. That's your difference. Okay. I'm hoping that this will record okay, even if you can't hear it right this minute. I'll check it when we get out of this. Okay. Number 4 is the other one I want to look at. Okay. This one I've already got the problems there, so I don't have to do it. Statement of stockholders' equity. In its most recent financial statements, Nestler reported $75 million of net income and $855 million of retained earnings. The previous retained earnings were $784 million. How much in dividends were paid, assuming they paid them? Okay, here's your formula right here. We saw it on that slide. End of year retained earnings is beginning of year plus net income minus dividend. If you want to solve for the dividend, just solve that equation around for dividend, right? Okay, so it's going to equal beginning of year. Where's our beginning of year? Beginning of year minus end of year plus net income. They paid $34 million in dividends. How are our algebra skills? We need to review those some. Okay, this one, statement of cash flows. Go away. Okay, Hampton Industries had $39,000 in cash at year-end 2018, $11,000 in cash at year-end 2019. The firm invested in property, plant, and equipment totaling $210. and cash flow from from financing was a positive 120. My internet connection is unstable again. Okay, there's all the given data. Again, here's your formula right there. We want to solve for operating. So I can take that equation and solve for operating. It's going to be cash at the end of the year, right there, minus cash at the beginning of the year, minus investing, plus financing. And if it doesn't come out, I should have done that wrong. No, I didn't think so. That one should have been right there. Should have been because it's already negative. No, that didn't work either. I know what it should be because I know what the answer is. Let's try that one again. Cash at the end of the year. I'll tell you what, scratch that. Let me just go over here to number 12. There it is. There's number 12, 62,000. I won't try it again and screw it up. There. So you'll have a formula sheet. You'll have the basic equation. It's asking you to just solve for one of the parts. And algebraically, you should be able to do that, even if I can't. Okay, let's look at number 17. 17's got all of this stuff up here, which I'm not going to read to you. It's Powell Panther. Here's their data. We're going to look for net operating working capital. We're going for free cash flow is what we're after. Okay, so net operating working capital for 2018 is current assets minus current liabilities, excluding notes payable. Whoop. And let me go down one more. Okay, so the change in, let me put these down here while I'm here right now. Okay, EBIT, I'll tell you what, I'll have to go up here to get it. This one, I'm gonna go back to the solution as well. Here it is. There you go. Go down one more. Here we go. Okay. Well, it's scooched by it again. There we are. Okay. There's our net operating working capital. So the change was negative. Net operating working capital went down by 18. EBIT came right off the statements up there. Tax rate came right off the statements. Depreciation came right off the statements. Fixed assets 2018 and 2019, they gave us net fixed assets. They screwed, whoop, I can't do it there. I gotta go back over here to it. Where is it? Notes payable. There, net plant and equipment. That's net fixed assets. So they're giving you net fixed assets for each year. So the change in net fixed assets, you're going to have to add depreciation back to that. Capital investment is the difference in those two. There's your answer. Questions about anything?
Are we supposed to be seeing a document or anything, or are we just listening and following along?
Are you not seeing an Excel spreadsheet?
No, ma'am.
No, ma'am.
I was excited. I was wondering if that's what you were
Well,
supposed to.
Yeah, I wanted to ask earlier, but I don't know. It was
No, you should always stop me if you're not seeing what you think you should see.
okay.
Well,
Well, let me just go back to it then. When it says share screen, when I'm in the classroom, that allows me to share whatever's on my screen. I don't have to go. I don't have to go pick other stuff. Oh, I hear the dogs. Okay. Well, you've already heard me talk about it. Now I will just show it to you. Complete it. There's number one. And I will go post these blank ones. So the blank template, so you can try it and make sure you understand how to get the numbers. But you can see the answers right here. This is the one where, and this would be as hard as we want to get on any of these financial statements. In other words, I don't care whether you know what goes into accounts payable and accruals, just how it fits into the great scheme. Okay, this one, I can make it a little bigger, maybe. There we go. This was the one where we were going for how much dividend they paid. Again, you've got a formula. It asks you to solve for dividend. Here it is. Retained earnings, beginning of the year plus net income minus dividends is equal to retained earnings at the end of the year. Well, you've got 4 numbers and they gave you 3 of them. So you should be able to solve for the 4th one. Basic algebra. Okay. Here was the one with cash at end of, again, cash at end of year, cash at beginning of year. This is a statement of cash flows. That was stockholders' equity. Here's cash flow. Same thing. There's your formula. They're asking you to solve for operations. So you plug in the numbers. What's going to make this come out? You know that, and that. What you plug in there that's going to make that come out? Is this better now? You're seeing the numbers?
Yes, we're seeing them.
Good. Way better. Okay, let me get this down to where you can see it. Okay. This was the last one where they had the whole income statement and balance sheet and all up there. This was kind of all inclusive. It took into account net operating working capital, reminding you the big thing is notes payable is not an operating liability. It's a financing liability. It's debt. They don't have any excess cash. If they did, it would be short-term investments. That's not an operating asset. So get those 2 numbers, there's the difference in them right there. Changing that operating working capital, the change between those 2. Now, depreciation was $30, 30, whatever. The change in net fixed assets was 50 plus depreciation. So the capital investment, remember back to our slide where it said, whoops, sorry about that. I don't think they'll. Remember, it's either the change in gross fixed assets or it's the change in net fixed assets right there, plus depreciation. Change in net fixed assets plus depreciation. That was the capital investment. When you plug all of that into the formula, you get a free cash flow of 80.5. I bet that made more sense when you saw the numbers. No comment?
I have to reread so much about accounting. It's not even funny just because it's been quite a while since I've had it.
Down here, see these end of chapter walkthroughs? These
Yes,
are
ma'am.
really good.
And this is in what category on the left is this in? This is in
This is under the lesson unit,
lesson units.
exam unit A.
Okay.
I'm in chapter 3 because there wasn't any problems in chapter 1. Go on down. There's your link to the ebook. There's the lecture video. And some chapters have 2 lecture videos because it was split in 2 parts. There's a PowerPoint. There's the PDF with notes. When I recorded this, I had a script. It's in the notes. Here's the problem walkthroughs. And this was from Dr. Bonnie Van Ness, who's our department chair. She taught with Zoom last fall, and this is some of her videos walking through them, and she's very good. But here they are. These are really good. This is something Cengage has added this year.
Cool.
And there's the one where we did the 3.1,
Okay.
3.8, 3.11. They do a lot of them. So. And
I got to get the acronyms in order is what I need because I can figure them out when I look at them long enough. But like when we have the spreadsheet and it has the acronyms in parentheses and it's been a while. So I got to figure out what they are.
Yeah. And do look at, let me see here. Lesson unit. Let me look at, let's see if it's there. I'm sure it is.
And I'm trying to get used to MindTap too. It's been a while since I've used it. So
Yeah,
I'm trying to figure out, is there a web page that I can pull up on MindTap that shows like I did, like it'll show you like your grades and on the side it'll show you what's due. Cause I want to figure out, I can look at the syllabus for that too, but it would be easier to access all together on MindTap. Cause I'm not here to mess around. I don't want to miss anything.
Yeah, it should. And I can't click on it because if I do it, it'll bring up everybody's grade. So I can't go there. Yes, you should. But if you have trouble with it, let me know and I can get Raybon to get in touch with you. And here's the equation sheet that you're going to have when you take the test. And let me show it to you here. It's right out of the back of the book. There. See, all of the equations. There they are. There's some blank pages because when you get it, it's a PDF and I can't do anything about that. But there they are. So you're going to have that when you're taking your test. So if
Good.
you, and most of them, see it, can I make it bigger? Yeah, there we go. Market to book, book value per share. I mean, it's not going to use the acronyms. It's coming right out of the book.
Well, your connection is 20 times better right now.
Yeah, I'm within 5 feet of the router.
Right.
I can see the little blue lights blinking here. But long term, I need to be up. My office is upstairs, but there's a computer down here. I'm in the great room. I mean, whatever that room is, that's the other half of your kitchen. You know, there's a fireplace and stuff.
Can I ask you, what kind of computer do you have?
This one I'm looking at is a Dell. The one upstairs is a Surface Pro.
Okay.
This is a big Dell. It's a big Dell. I don't know what it is.
Is your upstairs computer a laptop?
Yeah, it's a Surface Pro. It's a Microsoft Surface Pro.
Is it relatively new?
I guess I've had it a couple of years. The idea for it originally was to be able to, because you can write on it. I can write on that with a stylus and be able to work problems on it and record them and post them. Turned out, well, that works just fine if you're in a classroom that's not DL'd, not
Right.
distance learning. Whole new set of issues came in. I had to have an HDMI cable and this kind of, I mean, it turned out to not be all that good a thing, but
Well, I wonder if you're having the same problem that I have, because you have a stable enough internet connection that it's decent enough to use.
mhm.
But I'm using a computer from 2017 that I bought and it wasn't very expensive. There is a part in your computer. It's basically your Wi-Fi chip, and it can either be really cheap or not, or it can be expensive. You know, obviously the cheap stuff does not give you much of a radius. It's just weaker. But I have a feeling that that's an issue that you may have that I definitely have with my computer. That's why-
Upstairs probably. But let me tell you something. I went through this whole thing with Comcast, who I actually got a living human. And she said, finally, I mean, I can see the router. I'm looking at it from here. And I placed it right here on purpose so I can see it. I can see the little lights. And she said, you'd get a much better connection if you could use an Ethernet cable.
Right.
I'm connected through Ethernet. I ran a 25-foot cable around the back of the wall right up to this thing. So I'm direct connected to so the connection down here is great. I mean,
Right.
my gosh. So I'll have to figure out what we're going to do going forward and I don't know what I'm going to do at 6 o'clock because I've got another class. I guess I'll go try it. And if it doesn't work, I'll come back down here.
Right.
Right now, the boys are being really good. It won't last. I'm sure of that. Anyway, thank you all for hanging in there. Stop the share. There we go. I will check this recording. I will check the template. And any questions, let me know.